Okay, let's dive right into this. Welcome to today's explainer, where we're going to take a really structured, step-by-step look at one of the most common, but honestly frequently misunderstood, financial vehicles out there, the mutual fund. Whether you're setting up your very first investment account, maybe looking at your retirement options at work, or you just want to know where your money is actually going, you are in the exact right place. We're going to break this all down using some really clear visual steps.
Here's our roadmap for the day. We're going to quickly cover Meet the Mutual Fund, how mutual funds work, comparing funds and ETFs, benefits and risks, when investors use them, and finally, the impact of fees.
All right, Section 1, Meet the Mutual Fund.
So we really have to start with the most fundamental question. What exactly is a mutual fund? I mean, you hear this term thrown around constantly on financial news and in retirement brochures, right? But stripping away all that jargon to get to the core concept is absolutely crucial to empowering yourself as an investor.
Think of a mutual fund like a giant, professionally managed basket of investments. Instead of you going out to the market and trying to buy, say, one apple, one orange, and one banana all by yourself, you and thousands of other people just pool your money together. By combining your cash, you mutually buy this massive, curated basket of individual securities, like stocks and bonds. Basically, it's a way to buy a tiny slice of a much larger, highly diversified pie.
Moving right along to Section 2, How Mutual Funds Work.
The day-to-day mechanics of these things are actually pretty elegant. Because the fund pools money from so many different people, it has the serious capital needed to buy and sell securities in massive amounts. And that bulk purchasing power, it usually lowers transaction costs way down compared to what you'd pay if you were making all those individual trades yourself. Plus, this whole giant basket is overseen by professional money managers who do the heavy lifting of deciding what to buy and sell, giving you really easy exposure to a wide variety of underlying investments and the income they generate.
Now, as you look into mutual funds, you're inevitably going to bump into this acronym, NAV. Let's demystify this real quick so you don't get bogged down in finance speak. NAV just stands for net asset value. In plain English, it's the fund's total assets, meaning the value of all the stocks, bonds, and cash sitting in that basket, minus its total liabilities. That's it. So they take that total NAV and divide it by the number of outstanding shares to get the per share NAV. And that number is the actual price you pay to buy a share, or the price you get when you sell one. But here's the catch. Because the value of all those underlying stocks and bonds is bouncing up and down all day long, mutual funds generally just wait until the major U.S. markets close for the day. Then they sit down, do the math, and calculate the NAV. So unlike a regular stock, your mutual fund order only executes once per day, and everyone buying or selling that day gets the exact same price.
Okay, Section 3, Comparing Funds and ETFs.
Now, both of these are pooled investments, but what's really interesting is the structural difference in how they're priced and traded. Like we just talked about, mutual funds give you that end-of-day pricing at the NAV. They're also often actively managed by professionals trying to beat the market, and they let you buy fractional shares. On the flip side, ETFs, or exchange-traded funds, trade all day long on a stock exchange, so you buy and sell them intraday at whatever the fluctuating market price is. ETFs also mostly track passive indexes, and generally speaking, you have to buy them as whole shares without a minimum flat dollar investment.
Which brings us to Section 4, Benefits and Risks.
Look, every financial vehicle out there has two sides. On the plus side, mutual funds give you broad diversification instantly. Boom, you're diversified. You also get the total convenience of professional management constantly reviewing the portfolio for you. But, we have to look at the structural risks too. Your investment is absolutely subject to market volatility. The value can and will go down just as easily as it goes up. Also, there's a really unique tax consideration here. If the mutual fund manager sells securities inside the fund at a profit, it can trigger capital gains taxes for you, the shareholder. And get this, surprisingly, that can happen even if your personal investment in the overall fund is currently sitting at an unrealized loss. Wild, right?
Let's look at Section 5, When investors use them.
Because mutual funds let you buy fractional shares, they are incredibly practical for individuals setting up routine automated strategies. If you want to make regular deposits, like, say, automatically investing a frequent fixed dollar amount out of every single paycheck, mutual funds are usually the vehicle of choice. This lets you utilize dollar cost averaging, meaning you can fully invest that exact flat dollar amount every single time without needing to save up cash to buy whole shares.
And finally, Section 6, the impact of fees. Running a mutual fund isn't free,
and investors pay for this overhead through something called the operating expense ratio, or OER. Basically, these are the ongoing costs, think management and admin expenses, expressed as an annual percentage. Now, because these fees are paid directly out of the fund's assets, you are paying them indirectly. You're never going to get a bill in the mail for this, but make no mistake, these costs directly reduce your total returns over time.
It is so easy to see a tiny percentage fee and just dismiss it as insignificant. But to show you why that's a huge mistake, let's look at a mathematical scenario provided straight from the SEC. Imagine you invest $100,000 over 20 years. For this example, we'll assume a steady 4% annual return. Now let's translate those abstract percentages into concrete dollars by looking at 3 different fee levels. This brilliantly illustrates the silent power of compounding fees. If you look at this data from the SEC, all 3 scenarios start exactly the same, at $100,000, and they all grow at a 4% return. But over 20 years, they fan out drastically, entirely because of fees. The top path represents a 0.25% fee, the middle path is a 0.50% fee, and the bottom path, that's a 1.00% fee. Because the fees are taken out every single year, you literally lose the compounding growth on that money.
So here is the crucial point. Looking at the middle path, an annual fee of 0.50% reduces your final portfolio value by $10,000 compared to the path with a 0.25% fee. Seriously, a seemingly tiny 0.25% difference on paper translates to 10,000 actual dollars missing from your portfolio over 2 decades. But the reality becomes downright staggering when we look at the bottom path. A 1.00% annual fee consumes nearly $30,000 more of your portfolio compared to that 0.25% fee. The fund performed exactly the same, but the higher operating expenses just quietly ate away at your long-term growth.
The takeaway from this math is pretty undeniable, guys. The more you pay in fees, the less money you keep. It really is that simple. Mutual funds offer fantastic professional management and really vital diversification. But as a focused learner, you've got to remember that these ongoing operating expenses are an absolutely critical factor in your long-term success. Which leaves us with one final provocative thought for you to ponder today. Have you actually checked how your own investment fees might be impacting your long-term growth? Seriously, take a moment to review the operating expense ratios on your own investments. Finding out exactly what you're paying is honestly one of the most empowering steps you can take on your educational journey. Thank you so much for joining me for this explainer, and keep learning.